Hey traders from around the world, how are you doing this fine, fantastic day, afternoon, evening, or night, depending on where you are in the world and when you're watching this? It's your boy, Jerremy Alexander Newsome, and I am the CEO and co-owner of Real Life Trading. I'm here to talk to you today about what is a stock option. And this is really a basic class, but if you're here and you don't know what options are, it's totally fine, right? Don't worry about it being basic. There's a lot of things out there that I don't know that are pretty basic, like math, or spelling, like how to spell the word inconvenience. No idea how that one's put together. Anyway, so all I'm saying is if you're here and you're here to learn about call options, this is an entirely free class. It's not going to cost you a dime. There's not going to be any sales pitch at any point in this class. And congratulations, you saved yourself a few $1,000s because there's many classes that will charge an arm and a leg and maybe even a shoulder blade for this information. So let's talk about what is a stock option. An option is the choice to do something in trading. Is the choice to do something. That's what an option is. So let's spell out the word option. O-P-T-I. I did it right. Option. All right. So an option. So let's talk about the synonym for the word option for just a moment. Option means you have the choice. It could also be the right to do something, or maybe the privilege is another term possible for option. That's just a synonym for the word. Right? So option, you have the choice, you have the right, you have the privilege, the opportunity to do something in trading. So what I'm going to do is give you a few examples of what an option is, and this is going to be one of the examples that I like to use because this is kind of how I started out way back when was picking blackberries. So this is going to be a very random example, but let's say that this is a blackberry field or a patch of blackberries, and well, these are actually blueberries, so I'm just going to draw them. Okay, so this is a blueberry field. And you want to go and pick those blackberries. And this is a farmer, right? A farmer owns this field. And you say to the farmer, "Hello, farmer, I would like to pick your blackberries." And the farmer says, "Okay, let's do that." So you go and you begin picking blackberries or picking blueberries. So let's say in this example, you're picking this blueberries, and obviously it costs money to go into a farm and pick berries. So you pay some money. Let's say you pay $500. And you say to the farmer, "Man, these are some great blueberries. Like, I love these blueberries or blackberries." Let's just say berries. It doesn't matter. And you pay the farmer $500 to go and pick the fruit. $500. And you say, "All right, here's the deal. I want to be the only person allowed in this farm, in this field. I want to be the only person. I'll pay $500 for that right, for the choice, for the privilege, for the opportunity, for the option of being the only person in the blueberry or blackberry patch." And you pay that farmer $500. And the farmer's like, "All right, cool, $500. That's more than I'm making a week. I'm game. You're the only person in there for a period of time." So the farmer says, "I will give you," what's a good amount of time for a blueberry patch? I don't know, a day. "I'll give you one day. You can pick as many berries as your heart desires for $500. Enjoy. Have a blast." So you go, awesome. You go and pick the blackberries, and here's where the example gets a little strange. So let's say while you're picking these berries, and again, this time frame is just totally an example. It could be a day, a week, a year, a month. But let's say a giant beetle infestation takes over America, and all the other blackberry and blueberry fields evaporate. Or they get eaten. Evaporate's a terrible word. They get eaten. All the fruit gets eaten by these beetles, and you have the only blueberry and blackberry field in America that has not been affected by this beetle infestation. How much are those blackberries or blueberries now worth? And you would think that they would be increased in value because they're the only ones that exist. So here's your choice, or your right, or your privilege, or your opportunity, or your option. You have the option of picking these blackberries yourself, doing the manual labor yourself, and then turning around and selling those blueberries or blackberries for however much money you want to. Or you could call up a few people and say, "Hey, I have the option of being the only person in this blackberry patch. I will sell you that option for X number of dollars." Let's say it's $15,000, just as an example. So someone else says, sure, I'll do that. They buy the contract or the piece of paper from you. They buy the option to do with whatever the blueberries they want to do. Pick them manually, or they can sell the option to someone else, or whatever the case is. Does that make sense? Yeah, so it kind of gives you the option. It gives you the choice to do something. So let's explain in the stock market world. You have two choices, two privileges, opportunities, or options. You have the right, so R-I-G-H-T, the right to sell. This is pretty easy. Or you have the right to buy. The right to sell or the right to buy. If this makes sense to you really quickly, you always want to sell as high as possible and you always want to buy as low as possible. That's just common economics, right? You want to buy something at 10 and sell it for as high as you possibly can. Or you want to sell something as high as you possibly can, make as much money as you possibly can after you bought it, whatever. So those are the only two options you have available to you in the market. You have the right to sell something and you have the right to buy something. So before I break it down, let me just kind of give you an example, and I'll get a little bit more in depth into this in just one moment. But notice this is the SPY. And I'm going to turn on the line chart here. Just kind of give you a visual example of the SPY. The SPY is the ETF that tracks the Standard & Poor's, the S&P 500. I'm sure you've all heard of the S&P 500. So the SPY is how you can actually trade the general market. So if the general market is going up, the SPY is going up. If the general market is going down, the SPY is going down. So the right to buy. For an example, let's say the SPY does this over the next few weeks. I don't know if it will or not, but let's just say that it does. How would you like the ability to have hindsight and say, oh, now that it's at 212, I would love to be able to buy SPY down here at 187.40. Sounds kind of too good to be true, right? Well, not really. That's what a call option is. A call option is the right to buy. The right to buy. That's what a call option is. It is the right to buy something. If you are bullish on a trade, meaning you think you want the stock to go up, you want to make money as the stock increases in value, you want to make money as the stock trades higher, if you buy a call option, it is the right to buy. Since you always want the ability to buy at a lower value, let's do an example, and then I'll give you a real life example in just a second. Let's say you want the right to buy, and the market's open right now, so let's just go look at the SPY, and it's currently trading at let's call it 190. The SPY is trading at 190. So if the SPY is at 190 and the SPY goes up to 200, how many points is that? That is a 10-point move. $10 move on the SPY, so it goes from 190 to 200. I'm sure most of you watching this video understand buying shares. You could actually buy the shares of the SPY. You could buy physical shares. Let's say you buy 100 shares and the stock goes from 190 to 200. So 100 shares times $10 equals $1,000 of profit. That's how much money you would make on the shares. $100, right? That's the amount of shares that you buy times the value that it increases, 190 to 200, and then that would be $1,000 profit. On a call option, let's hop over here to the call option side, and I'm going to give you a really quick example here. Here's the SPY, and you might have never noticed this before, but if you go to Yahoo Finance and you click on a ticker, whatever the ticker is, right here on the left-hand side it says options. Click on options, and this is what's called an option chain. I'm going to break this down to you for just a moment, but here is your strike prices and your expiration dates. So remember earlier in the farmer, I said that there's going to be an expiration date. All options have an expiration date because if you want the right to do something, you only have a certain amount of time to do it. So let's just use February as an example, February 2016. And right now, a 190 call option costs you $4.36. $4.36. That's how much the option cost. If you're going to go buy, let's say instead of buying 100 shares of the SPY, you wanted the right to buy 100 shares of SPY. Okay? You want the right to buy it. Doesn't mean that you're going to. You want the ability, if you want to, if you feel like it, if you feel like picking blackberries after the Beatles have taken over America and eaten all the other blackberries, if you feel like owning shares, you can. It is your option, your choice, your right. So in the example of the SPY, coming back over here to the charts, if the SPY went from 190 to 200, that is a 10-point move. The option that we just looked at was worth $4.36. So all things else equal, if SPY went from 190 to 200, how much would this option be worth? Stock went from 190 to 200, moved 10 points, all else equal, and I'll kind of explain that at some point, but what else, how much would this be worth? That option would be worth approximately $14.36. There you go. $14.36. Boom. All right, 10 plus 4.36 is $14.36. What's interesting about that? Well, you may notice, but this $4.36 is a real value. Like, that's literally how much you would be able to buy the share. Literally how much you're going to pay on that option. So the amount it would cost you would be $436 if you bought one of them. I'll explain that in just a second. After the 10-point move, you would be able to, if you wanted to, sell it for $1,436. $1,436. So remember, on the SPY, stock went up, you made $1,000 a share. The contract you buy, you made $1,000 as well. So you're making the same amount of money, but the investment is much, much lower on an option. Much lower, in fact. So remember, on a call option, you're only buying $4.36. You're investing $436, and your ROI is about 300%. A little bit more than that, actually, but 300%. And yes, 300% return on your investment. Pretty dope. I think it's awesome. So that's a little bit of why people love options so much. Now, here's the sweet part. So the option costs you $4.36. You have the right to buy SPY at 190, right? That's the value at which it's trading right now. You have the right to buy it, and the stock goes up to SPY goes up to 200, boom, 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 and you have the right to own shares. So at that particular point in time, let's say the SPY goes up to 200, and you want to actually own the shares of SPY. You have the right to buy it. So what could you do? You could call your broker on the phone and say, hey, broker, I now would like to exercise my option and actually own the 100 shares of SPY. Beep, right? So there's your 100 shares. So now you actually own the shares if you want. Or in the BlackBerry example, you could sell your option to someone else in the world. And if you're wondering who else, it doesn't matter. Someone else in the world will exercise that option the moment you sell it. If you buy it for $4.36, the stock goes up to $14.36, or the option, you'll be able to sell it. On stocks that are very, very popular traded. Like, of course, SPY, Apple, Google, all those. I've never had any problem getting in or out of an option. So let me reiterate this really quickly. If you're interested in trading options, you do not ever, 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 ever need to actually trade the stock if you don't want to. You never have to touch shares in your entire life. You can literally just trade the option itself. So it's really interesting, especially for traders who might have smaller accounts. They really get excited about options because there's the ability and the leverage there that you can increase small accounts pretty quickly. Right? So if you're starting out with $2,500, you could buy one contract of SPY for $4.36. It would cost you $436 of your $2,500 investment. So it's definitely possible. With a small account, you can trade options. So a call option is the right to buy. And remember, you always want to buy lower. There is something else out there called a put option. A put option. What in the heck is a put option? Well, if a call option is the right to buy, what do you think a put option would be? Put option would be the right to sell something. The right to sell. That's what a put option is. So a put option goes up when the stock goes down. Call options work very similar to stock. If you buy a call option, it goes up if the stock goes up. So if you buy a call option, it's the same equivalent direction as buying shares. Okay? The right to buy, you buy a call option and you sell it for a higher value if the stock goes up. That's your objective. A put option actually goes up in value when the market goes down. And some of you are saying, that sounds impossible. It doesn't sound like that's legal. It's very legal and very possible, and I'll explain why. Let me hop over here to ticker symbol USO, which is the United States Oil Fund. United States Oil Fund, and let's say, for example, you are owning shares currently of USO, and you bought them right here at $16. So obviously you can see that you're in a little bit of pain. The stock has decreased over 50%, or at one point about 50%, in value in the course of a few months. So you're a sad panda. You're not happy. You bought the stock at 16. It's now at $9.20. How would you like the right, the choice, the opportunity, the privilege, or the option to be able to go back and sell it at $16? And you're probably saying, yeah, please, can I have a few? That's what a put option is. Think of put options, and the best way I can explain put options, and really, and seriously, this is why they were created. Put options are stock insurance. That is what a put option is. Stock insurance. It mitigates the losses that are potential in the case of a downturn or bearish market. What other things do you have insurance on in your life? Oh, I don't know. House, car, life, maybe a few other things. But those are some big deals, right? A house is obviously the most popular investment that people make. And everyone has house insurance, mostly because you're required to, but also you'd want to in the case of something bad happened. Why don't people have stock insurance? Makes zero sense to me. Everyone and their mother knows about home insurance. No one and their mother knows about stock insurance. And this is something that I love teaching people because it really is a big eye-opening experience. And I'm saying, yes, you can buy options to protect yourself in case the stock that you own or the market goes down. They're called put options. So, for example, you buy a stock at $16 and then you buy the $15 put option. So you buy the stock at $16, you buy the $15 put option, and this is what happened in the stock. Ladies and gentlemen, your loss in this situation would be $1 a share. Yes, you lost money. It's going to happen often when you're trading the stock market. Not a bad thing. I lose 50% of my trades. I'm a very active trader, so for those of you who might be watching this who are buy and hold investors or longer term traders and you just hold and hold and hold, the put option is an amazing thing for you. And the reason I say that is because you don't have to use stops. You don't have to exit the trade for a realized loss. The put option is great if you want to hold the shares for capital gains or dividends, or maybe you just want to hold them forever and give them to your kids or your grandkids as an inheritance. Maybe you work for the company and you can't sell the stock and you don't want to sell the stock. So when the market is going down or when the stock's going down, you can buy put options to simply offset the costs and offset the losses. So in this situation, USO, buy the stock at 16, buy a put option at 15, and instead of losing, $7 per share, you only lost $1 per share. That's called loss mitigation, and that's smart. So now that you know USO is down here at $9.20. You have two choices, two privileges, two rights, two opportunities, or two options. What are those two options? Stay tuned for the next Coca-Cola commercial and I'll tell you. I'm just kidding. So the two options that you have are either sell your stock or sell the option. Those are your two choices. What do I mean by sell the stock? Well, literally, you have the right to sell it at 15. So if you call your broker and say, hey, Mr. Schwab, I took a little bit of a bath on USO, and he's like, man, you sure did, Gertrude. Good thing you bought put options. And you're like, yeah, I'm a real life trader, no big deal. And you brush the dirt off your shoulders. Okay, you only lost $1 per share. It's okay. So that's your option. That's your right. That's your privilege. You have the ability to sell your shares at $15. And again, or you just simply sell the put. So let's go back and look and see what a January, let's just do February since we're here. Let's say back in time in October, you bought a February put option, $15 put option. How much would that be worth right now? It would be worth right this second, $6, yeah, about $6. $5.70 is how much it's worth right now. $5.70. So if you wanted to, you could sell that put option, right? It's your opportunity, your privilege to do so. You could sell it, bring money in, right? Bring money in, bring cash into your account. And if you want to own USO longer term with that cash, you could always buy more shares. If you wanted to. Again, that's your choice. Or really, there is a third choice out there. You could have just bought the put option. You didn't have to touch shares at all. Let's say you were actually bearish on USO once it broke this little support line, or once it broke this little support line right here, either one. And let's say you bought a February put option for $15. And let's just, again, hypothetically say you bought it for $2.30, and right now it's worth $5.70. Ladies and gentlemen, I'm no math wizard, but that's over a 100% return on your original purchase, right? You purchased the original option at $2.30, and you have the right to sell it at $5.70. Now, for some of those who might be new to real life trading, you might say, whoa. Newsome, the guy with the big head talking. This sounds great and all, but I have no idea when to buy these options. Well, therein lies the beautiful part of trading. Okay, you have strategies. Strategies are the easy part. I can teach you strategies all day long. In fact, I just taught you two. Buy a call option for $1 and sell it for $2. That's a strategy. Buy a put option for $1, sell it for $3. That's a strategy. Put options go up when the market goes down. Call options go up when the market goes up. The strategies are the easy part of trading. Once you learn the strategies, they never change. The strategies are the same Monday as they are next Monday or the Monday after that. They're the same. The strategies do not change. The market is what changes every single day. You do have to learn about technical analysis. You do have to learn about candlestick patterns. You should learn about support and resistance, and absolutely 100% learn about risk reward, entries, stops, targets, and how to create a trading plan. I know it sounds like it's going to be a very expensive thing to do. If you would be so kind to go into reallifetrading.com and you can click on any of our educational tabs. Every video, every article, every blog that I've created is entirely free. It won't cost you one single American cent except some of your time and your internet connection to watch these articles or read the videos. Read the articles, watch the videos. That's what I tried to say. So it won't cost you any money to do that. If you really want to learn about technical analysis, we have really fantastic analysis education, in my opinion, one of the best out there. There's a lot of other people who teach trading. I just happen to be one of them, and we just happen to be the least expensive. So anyway, that's kind of the strategies of options. Now, let me just tell you why they were created. Options were created as an insurance tool. They're created as an insurance. So remember, a put is a stock insurance. A put is an insurance that protects you from your investment going down. Technically, a call option is the exact same thing. For those of you who are brand new to trading or maybe totally new to options and the world of options, this kind of might confuse you, but a call option was actually created to protect you in the case that the market goes up. Why in the world would you want to be protected if the market goes up? Well, there are some crazy psychos out there like me who like to short stocks. Shorting stocks means you're bearish on the stock. You want the stock to go down and you want to make money as the stock goes down. If you don't know how to short stocks, I will include in the comment section below the video on you can watch to learn how to short stock, but I'll make it very simple. You've heard of the term buy low, sell high. You've all heard that term. What about sell high, buy low? Just a little bit of a teaser to whet your taste buds. But again, in the comment section below is the video on what selling short means. But that's why call options were created. Now again, just as a reiteration, you never have to take possession of the stock to trade options. You can buy a call option and sell it anytime you want. You can buy a put option and sell it anytime you want, comma, before the expiration. Option expiration is one of the biggest things that gets people in the most trouble. All options have an expiration date because it's not really valuable if you don't have an expiration date on telling someone when something's going to happen, right? So if you tell someone, I'm going to have a baby, when? I don't know. It's not really going to be a valuable tool. The reason options have expiration dates is because they have to. They're insurance. You can't just have insurance for your entire life for a fixed cost. There always is there an end to insurance, at least as far as I know. So that's the most common mistake out there is buying an option that does not have enough time. For newer traders, and I'm going to calculate newer traders as anyone with 2 years or less of experience. 2 years of less experience, you should buy an option with 3 months of time. 3 months of time. What does 3 months of time mean exactly? Well, count 3 months forward from where you are right now. So as I speak, it's January. So January to February is 1 month. February to March, 2 months. March to April is 3 months. There you go. So on USO, for example, let's do an example in USO. Let's say I wanted to buy an option and I wanted the stock to go up and I wanted to make money as the stock goes up. What option could I buy, ladies and gentlemen? What option could I buy? If I want to make money as the stock goes up, I would want to buy, bing, 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 a call option. Yes. So I come over here to USO, and I just said that I would want to buy an April call option. So here's April. And notice the Yahoo Finance option chain, it says what you're looking at. So these are puts right there. These are calls right there. Notice that. Okay, the strike price, notice how it says strike. That's just the value at which you have the right to buy the stock if you want. If you want. Okay, the right to buy the stock if you want to. So let's say that we want to buy the $9 stock option on USO for April. It's going to cost us $1.16. You always buy at the ask, you always sell at the bid. That's the case with everything in trading. You always buy at the ask, you always sell at the bid. Sell at the bid, buy at the ask, sell at the bid, buy at the ask, buy at the ask, sell at the bid. It's always the case. It's the case with options. And you can notice here in April, you have an ask and you have a bid. Here's what's interesting about options. Notice the difference in these two numbers. This is called the bid-ask spread. This is also something that will absolutely ruin your life in option trading if you're not careful. Stocks themselves usually only have pennies on the spread, like cents, 2 or 3 cents. This has 12 cents. This has 12 cents. So imagine you were buying one option, which is called a contract. Okay, right? It's a contract. It's not anything written in stone. It's not legally binding in the sense that you can get sued or anything like that. You could technically have margin. You could have a margin call if you don't do the trades right. But here's the best news about buying an option. Okay, we'll talk about selling options in some advanced classes, but buying an option, the most you can lose on that option, and this is good news, is your investment. So if you buy an option, yeah, there's no legal recourse that's happening. I say contract, but that's the term that it's used, but there is nothing like scary. There's no bankruptcy, nothing like that. You can only lose your investment. So if you buy one contract, that would cost you $116. How do I know that? Every contract of an option controls 100 shares. 100 shares. There are a few stocks out there that have what's called mini options. They work the exact same, but they only control 10 shares. Trust me, you'll know when you're buying a mini because it'll say, hey, you're buying a mini option. All right. So for right now, for the majority of our practices, every contract controls 100 shares. So if you were to buy 100 shares or one contract of this particular stock option, it would cost you $116. If right away, as soon as you bought it, you went and sold it, you would sell it for $104. So you would lose $12 plus in and out commission. So if you bought it and you immediately sold it, all right, the second you buy this option, you'd be underwater a little bit. You'd be underwater a bit. $12 to be exact. Now that can increase if you bought, 10 contracts. Okay, 10 contracts, you would spend $1,160, and then immediately you'd be in the hole. What is that? $120. Immediately upon buying it, you're losing $120 if you bought 10 contracts. So I'm sure many of you are familiar with limit orders and things of that nature to try to get a better fill. So let's say that you're Jane and you're smart, and you try to come in here and buy it for $110. Rather than $116, the lowest you'll ever buy it for would be $104, and the highest you would buy it for is the market ask price, which is $116. Try to get somewhere in the middle will be about $110. And so that just helps offset the initial downside cost of the option. Again, the best news about buying an option is you can only lose 100% of the investment. So let's say that USO goes lower, okay? So let's go back to the chart really quick. Here's your stock. Let's say the stock does this, beep, and just tanks. How much you're going to lose? You're going to lose exactly what you paid for it. $116 or $110, whatever. You're going to lose that investment. Can you mitigate that loss and place stops? Of course you can. Absolutely. Matter of fact, I did that on the screen right there. So let's say you buy an option right there, set your stop right here, and you want to calculate, again, how much risk that would be. You might be familiar at this time by R trading. Again, if you're not familiar with the risk concepts of trading, hop over to reallifetrading.com. But this is how I personally calculate how many options I'm going to buy. We all should know our R value. Our R should be 1 to 2% of our account. So let's say you have a $5,000 account. If you have a $5,000 account, 2% of that is $100. So you should have a $100 R. The way you calculate your share, the amount of options that you buy, is you have a trigger. So let's say your trigger is $9.13. Your stop is $7.80. You take the difference. $9.13 minus $7.80 equals $1.33. From here, you normally divide 100 by your stop value. So 100 divided by $1.33 equals 75 shares. 75 shares. So I just mentioned one call option or one put option. One option contract controls 100 shares. So if you could only buy 75 shares in order to lose $100, that's approximately how many call options you should buy. You should buy one, maybe two. But that gives you an idea of how many options you should buy to be able to control your risk and keep it at a nice comfortable amount. Again, what a lot of traders will do is they'll say to themselves, oh my goodness, this thing I can buy for $116, I'm going to buy a megaton of them. If I have a $5,000 account, shoot, I'm going to buy 10. I'm going to buy 10. It's only going to cost me $1,160. That's all it's going to cost me. And if USO trades all the way up to here, boom, 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 $12.50, how much will the option be worth? Well, it'll be worth approximately $4 So you're saying, Jeremy, that's a 400% return. Are you crazy? Why would I not do that on every single trade? Because what goes up can go down, ladies and gentlemen. It's all about risk mitigation. You start doing that now. What about when you have a $50,000 account? And instead of $1,000, it's $11,000 of an investment. Remember what I said, you can lose 100% of your investment. Options, ladies and gentlemen, move very, very fast. I will throw this little tidbit out there. This is just my opinion and my advice from a non-licensed person, just an educator. Trading stocks is like driving a silver 2010 Toyota Corolla regular edition. If you don't know how to drive a silver 2010 regular Toyota Corolla, you probably shouldn't drive a NASCAR, a race car. That's what an option is. An option is a race car. A stock is a Toyota Corolla. So if you can't make money simply buying and selling stock, you should probably wait until you are profitable before you trade options. Because an option is also called a derivative. It's a derivative of the stock value. I understand that it's a really alluring tool for people with smaller accounts. I'm just letting you know, if you can't trade stocks profitably, you're probably going to have a very hard time trading options profitably. I'm not saying it's impossible, but the percentages are very, very low. Because you're going to have to understand patience, you're going to have to understand time management, you're going to have to understand discipline, you're going to have to understand charting, trading plans, risk mitigation, entry signals, candlesticks. I mean, there's a lot that go into an active trader. I will say, however, if you do want to trade options, the two easiest, safest, and best strategies, in my personal opinion, for option trading is something called a covered call, and as I mentioned just a moment ago, the protective put. Covered call and protective put. These are strategies that can help protect your account, can bring money in. The covered call brings money in, and the protective put protects you in case of market downturns. So if you want to trade stocks, or if you have a bigger account, by bigger account, let's just say a large account. I'll let you define what large means. But if you have an account that's large with a lot of shares or a lot of equity, or it's a nice size, you probably want to learn, if you're not an active trader, if your objective is not to actively trade, but to just work at your job, you love your job, keep adding to your 401k or IRA or whatever, RRSP, keep adding to your funds over time, and you love your job, you're going to work at your job, keep growing it, but just trade options on the side as a protection. These two would probably be the way to go, in my opinion, my non-licensed, just education opinion. That's really a pretty solid real-life overview, ladies and gentlemen, of options. There are even more tools that go into options. Here's the most interesting thing, ladies and gentlemen. Again, stock is very simple. Stock, there is nothing special about stock. You either buy it or you sell it. That's it. You have two choices. You buy or sell. You're long or you're short. You're bullish or you're bearish. Options, ladies and gentlemen, make the game much, much more intense. There are literally hundreds of thousands of option strategies that you can do. Hundreds of thousands. There's a lot. Don't be overwhelmed by the strategies. Find the most simple, the most basic strategy possible, and stick to that and see if you can make some money trading. Because obviously that's your objective. Your objective is to make some money trading. So what would be a really simple strategy? Well, find a support, and if the stock bounces off of it, buy some calls. If the stock breaks through it, buy some puts. The question is which ones to buy. Well, I already mentioned buy ones with 3 months of time. From there, the easiest thing to remember is buy the option that's closest to the value of the stock. Those are called at the money. Buy the one that's closest to the value of the stock. What's great about this is all option chains have a little bit of a coloring. See this coloring right here on USO? This is like light blue, and then this is like light white. This coloring shows you something that's called in the money and out of the money. In the money options are the safest to buy because they are the least volatile. So in the money literally means if you buy a call option, right, you want the right to buy something at a certain price. If the stock price is already above the strike price, you would theoretically have a better probability of knowing if you have the right to buy it at 9 because you can already buy it at 9.20. So obviously you could have bought it at 9 at some point. So the value of the option would be greater. So I'll say that again. If a stock value is higher than the strike price for a call option, it's going to be in the money, meaning it's a little bit more of a safer wager, if you will, theoretically. Right? The probabilities of the option being over $9 at expiration are a little bit greater if it's in the money. So let's practice with Apple really quick. And here's Apple. And really, you can draw, anytime you pull up a chart, you can draw a line. Find out where the stock price is, wherever that stock price is, and draw a line. So right now in Apple, it's $171, almost $101. So this line shows you in the money and out of the money. Anything above the line that you draw is in the money for put options. Anything below the line is in the money for call options. So why do I say it's in the money for a put? Well, think about it like this. A put option is the right to sell. If I told you, hey, I want the right to sell Apple for 112. You're like, yeah, that'd be fantastic, man, because right now it's at 100. Right? So remember, go out to someone who has shares and say, hey, how would you like to sell your shares of Apple at 112? Would that be valuable to them? And my answer is yeah, of course, because right now Apple's at 100. So that's going to be in the money. This does take a little bit of practice, but again, the simplest way is to draw a line on your screen wherever the stock is trading. So let's go do another one. Let's go do Google, and I'll draw a line. Where is the stock trading? Boom. Here's the stock right now. Boop. That's where it is. Draw a line on your screen. This is in the money, and this is in the money. What option is this in the money for below? Calls. What option is this in the money for? Puts. So when you're buying an option, you want to buy in the money. In the money. So back over here to the USO example. Notice this is kind of my analysis, if you will. I'm not going to personally do this trade because there's no real buying signals down here. This is a pretty aggressive trade. I'm not saying that USO doesn't go higher. In fact, I think it does something like this and then rolls over again. That's just what I think. I could be totally wrong about that. But anyway, this is what USO looks like right now. So let's draw the line. Here's where the stock is trading. This is in the money for puts, and this is in the money for calls. So we're going to want to hop over here, look at the option price. There's your line right there. This is out of the money. This is in the money. And again, this is colored for you. Here's your price. You could buy April for $1.16. Hasn't changed at all since we've been talking. Just as a reminder, you can always sell your option before the expiration. In fact, I insanely suggest doing so. Always sell your option before expiration. Why? Because the closer to expiration you get, the less your option will be valued. Option values look a little bit like this. And this is your expiration. They kind of stay stable for a while. So let's say that USO doesn't move at all. It stays at $9.20 for the next month. This option would be about $1.12. It wouldn't change very much between here and February. Okay, so let's say USO stays $9.12 coming into March. That option would probably be worth about, 58 cents come March. Then let's say it's April 14th and USO is still at $9.20. the $9 option would be worth about 19 cents. So you can see that the option value does decrease quite significantly. And as a reminder and a reiteration, yes, you can use a stop on option value. You can also place a stop using the stock price. So for example, you can have a broker that says if USO is below $7.80 in the stock price, then exit my call option. And obviously you would exit your call option for a loss if you bought it and the stock went down. There's a big world out there in trading, ladies and gentlemen. It's a really, really fascinating world. And my objective is just to educate people, and my mission is to enrich lives. And hopefully you've learned some things in this particular video. If you have any questions about any part of this, feel free to email me anytime at jeremy@reallifetrading.com. You can also find me on Twitter at Newsome Nuggets. And I'm happy to assist in any way I can. There are a lot of complexities with options, and truly and sincerely, it really is kind of like, you know, a Toyota Corolla, and being able to work on a NASCAR and then drive a NASCAR and then market a NASCAR and then advertise for NASCAR. I mean, options are so many different variables out there. There really is, I mean, truly so many variables that change every single day. And sometimes trading the markets, the stocks themselves, can be hard enough. So doing options just adds a little bit of an additional thing. But if you do have a smaller account, it can be a really good tool. If you do have a very, very large account, it can be a great tool to protect you in market downturns, right? Buying stock insurance and kind of going that route. So also on the bottom of the section, the comment section below, click that little more link. And there's also the video in there for protective puts. I kind of explain that as well. And if you have any other questions about trading or options in general, you can always, like I mentioned, email me. You can post a comment or a question below in the YouTube section. Please feel free to subscribe to our YouTube channel. We are on Facebook. We are on LinkedIn. All the social media jazz. We're there, ladies and gentlemen. I hope you enjoyed this session and this class and this video. Look forward to seeing you in the next one. And until then, remember, love life, live life, and trade it. See ya.